You may be thinking, now is a great time to buy a second home or investment property. Having enough money for a down payment on a new home is often one of the biggest struggles homeowners face. You may not want to tap into your existing nest egg, and you may be wondering if it's possible to tap into the equity you have in your existing house. For some homeowners who already have a home, you can leverage some of the equity you have built up to maybe acquire another house. There are a few different options for using your equity in your existing house, and you always want to consult your accountant to find out any tax implications, and perhaps your financial advisor to find out if buying another property fits in with your long-term investment strategy. So let's look at some options you may have to tap into the equity of your existing home. The first option you may consider is to refinance your existing home with a cash-out refinance home loan. A cash-out refi allows you to tap into the equity in your home and take cash out. This cash can be used to remodel your home, pay off bills, or put your kids through college. This money could also be used as a down payment on another property. There is often seasoning requirements on your down payment funds when you buy a new home, so you'll want to check with your mortgage lender on the requirements. But refinancing your existing property may allow you to tap into your equity and use it for a down payment on another home. Interest rates on primary residences are usually lower than on investment homes. With a cash-out refinance, your total loan amount typically cannot exceed 80% of your home's value. Another way to tap into the equity in your existing house is to take out a second mortgage. There are many second mortgage options available, including a home equity line of credit or a HELOC loan. A HELOC works like a line of credit against your home. You do not have to draw all the funds out with a HELOC home loan, and it may provide you with the funds needed to buy a home as a rental or even consider buying a home and fixing it up to sell. There are always potential downsides to cashing out your home equity. Depending on your overall financial circumstance, you may be able to potentially claim tax deductions for interest payments on a refinance loan tied to your primary residence. You can also potentially write off interest payments on a second lien equity loan or line of credit. Equity lines work similarly to credit cards because you have access to a revolving line of credit, and you have the option of making interest-only payments for a certain number of years. Before you begin the process, be sure to check with your accountant to find out your options. When you use your existing home equity to finance a second home, you stand to lose your primary house if you fall behind on the loan payments. Equity lines of credit usually have variable interest rates, which means your payments could skyrocket over the course of time. Home equity loans tend to have shorter terms than standard mortgages, which means you may have a larger monthly payment to manage. If your payments fall within your budget, then a cash-out refinance or equity line may make sense. But if funds are tight, then the cons may outweigh the pros. Whatever you decide, be sure you're working with your accountant, your financial advisor, and of course, a licensed mortgage professional. You may be sitting on an opportunity to expand your homeownership with the equity in your existing home.
Hi, I'm Lori McMortgage, and I help people buy homes when they don't have the cash to pay for it. If it's your first home, your next home, or your rental home, my team and I will make sure you have the right financing in place and the process is smooth and easy. Thank you so much for watching today. I hope you enjoyed the video, and please reach out to us at the information provided. We can't wait to talk to you.